So today, what we're going to do is we're going to pick up where we left off on the video on Monday with the finishing up the valuation model. And then coming up for this coming Monday, you're going to have two-part homework assignment. It's called Homework 7, right? So the first half of Homework 7 is to complete what we do in class today. So if you're able to follow along and complete in class, you're done. You could submit to Homework 7, and that's half of Homework 7. Okay? The other half of Homework 7 involves Bloomberg. Okay? So, and I had mentioned this in class on Monday. If you look at I have it here on my desktop, but basically there's a file called cat.xlsx. And you can find it in the Files section of Elms under the folder called cat model. That's this file, cat.xlsx. Okay? So what this cat file represents is this is the data from Bloomberg that was exported that we're using to do our valuation of the company with in a standardized way. Okay, so for next week, as an additional company, we're going to finish valuing Cat, then we're going to look at one of Cat's peers, Komatsu. Okay, so what I want you to do is I need you to get the data for Komatsu ready to go so we can take the valuation model we build and we can swap out Komatsu's data. So we're building a reusable model. Okay, so in our model, there's a tab, the very first tab, which is the data tab, which is this model data. All right? So where this comes from, and this is what you're going to have to do, is in Bloomberg, sorry, I think Microsoft might have kicked me out and went to sleep. But you're going to have to log into Bloomberg, and in the FA section of Bloomberg, you're going to have to create a custom template. Okay, so let me try and quickly log into Bloomberg here. Sorry about the login process taking a second. All right, so once you log into Bloomberg, you can go to any company. In this case, I'll do CAT, so CAT US Equity. And then you go to the FA section. This is where you get the historical financial data. And then you go to the Custom tab. And on the Custom tab, you can create a series of custom templates. Okay? Now, when you create the custom templates, it says Create Custom. So click on Create Custom, and it'll create a blank template. So here's where you can start entering the fields. Now, in the Excel file, this CAT file, these are the field names in Bloomberg, the actual field names in their database, and these are the friendly names in Bloomberg. So what's important is you have to put these fields in this order. So there's like 70-odd fields. You have to put them in this order, okay? Because when you export that custom template to Excel, it's got to go in that order because that's the order the model's expecting it to then make it a reusable model. Okay? So, for example, revenue, sales underscore rev underscore turn. So I could actually type in the less friendly name, sales underscore rev underscore turn for turnover. And again, it'll tell me what the first field is that has that exact name. It's revenue. Click enter. Revenue is on the list. Okay, so that's option A. Option B is I could choose the non-friendly term, cost of revenue. Start typing in cost, or the friendly term, cost of revenue. And then I just had to make sure that I chose the right cost of revenue when I do the field. Okay, and if I hover over it, IS COGS to FE and PP and G, and then that's IS COGS, FE, and PP and G. Okay, so I can do it either way. And then here's the third piece of the process, which is I could take something like gross profit, I can copy it, I can come in here, I could paste it, and then instead of typing, which I know it gets tedious when you have to do it 70 times, you can copy and paste. I would use the actual Bloomberg field name for the database, and then just hit enter, and then it will either search for it, or you can click on it and add it and update the value. Okay, but that's what I'm saying. You have to do this for all of these fields in this order. There's like 70, was it 75 of them, something like that. Okay, so that's the second half of the homework. Okay, so you need to create that as a custom template. When you're done, click on save, name it whatever you wanted. I named mine model, okay, but you name it whatever you want, because this is going to be reused. So when we do a homework assignment, we do an in-class valuation, or when you do your group project, this is the template you're going to use to export the data for the valuation model. So one tedious time to create it. Once it's there, real easy to export, because you can just go back to the model tab. So that's my idea. So here, I'll click on more. I have a tab called model, and then this is that file, which I'm then ready to export. Now, the other thing is, when you export, click on the settings of Bloomberg, which are tied to your individual account, and make sure you have the following settings. So we're going to use 6 years of historical data, so make sure number of periods says 6. I think it defaults to 10 in your account. So you only want 6 years of data, because the model's not looking for more than 6. Right? And then make sure it says standardized. Should by default, but just make sure it says standardized. Under the data tab, make sure none of these are checked, because you don't want to have any extra columns in your export. You just want the historical data. Under display, make sure it says ascending. Ascending means the most current year is on the right. Descending means the most current year will be on the left. Our model would expect the current year to be on the right. Okay, so we're going left to right. So make sure it's in ascending order. And then finally, on the report Excel setting, make sure it says export as value, not formula. If you export it as a formula, there's an advantage in that Bloomberg will literally stick those fields as formulas as database lookups in your Excel file. So every time you open Excel, it will auto-update the template. And it's nice because you can literally just change the company name, and then it'll just open up Excel and refresh. That's where all the custom templates come for in Bloomberg. The problem with that is it requires you to be at an active Bloomberg terminal, otherwise logged in, otherwise it'll just error out. All right, so since most of what you're going to be doing will be outside the Bloomberg lab and you won't have access to a Bloomberg terminal, export as values, which means Bloomberg will give you actual numbers as opposed to database lookups. Okay, but theoretically, if you wanted to, you can create your own templates. And Bloomberg has, as you saw in the Bloomberg demo, an Excel template library of like 200 and something Excel files. That's what they do. They just create Excel models that have database lookups. You open up the template and it just refreshes the data in real time. But it requires an active Bloomberg session to do that. So since we're going to be doing a lot of work outside the lab, export as values. Right? Hit update. Once you've done that, then go to Komatsu. So you can quickly, if you're on the FA section, go there, or you can type it across the top. But I want to go to Komatsu JT Equity, so Tokyo, so 6301 Tokyo Equity on the Tokyo Stock Exchange, with the model template. Just make sure I have the right one that you've created, and then the final step is go to Output Excel Current Template. So what it's going to do, and very important, every time Excel exports to, it's going to give you a security warning that says, is it okay to import this data? You have to say yes, because otherwise it will not finish the import until you say yes. Right? Because Bloomberg exports an XML file, which Microsoft treats as a security risk. So you say yes, and then there's the data for Komatsu with the model file, or with the company you just chose. So if my company was Lockheed Martin, then I just choose Lockheed Martin, export. If my company's Raytheon, choose Raytheon, export. So this is how we're going to use the reusable model once we build this. Finally, when you save this, go to File, Save As, put it somewhere in your computer. Make sure, because it gives it to you as an XML format, save it as an Excel workbook, XLS file, or XLSX. Right? And again, I'll call this Komatsu and save. All right, so that's the other half of homework 7. All right, so the first half of homework 7 is to upload the final valuation file for CAT, and then the second half is create this reusable file with Komatsu's data, so that on Monday, when we get to that class, after we finish the valuation of CAT, we'll then alternatively value Komatsu. As I said, it'll take about 10 minutes to copy and paste and update the new data to use the model to get going with Komatsu. But that'll be our practice because, again, your group projects will be using the same format. Does that make sense? Questions about that? Should take you about 20 minutes to create that file in Bloomberg. Okay, and again, the simplest way, copy paste. I know it's tedious, you'll have to do it like 75 times, but rather than typing, that's the simplest way to do it because you want to make sure you get the right fields in the right order. Because unfortunately, Bloomberg has many fields which are very similar to each other. And if you have the wrong field, it could cause problems with the model. So to be exact, use the fields that are there. Okay. All right, so let's talk about our valuation. So where we left off in the video on Monday, which I'm going to pick up with right now, is here, and I'm going to name this part 2 of our valuation. So we will continue on from where we left off. All right, so what we did on Monday, just as a refresher, is we created 6 years worth of ratios, which created 6 years worth of income statements and balance sheet forecast, which created 6 years ultimately of cash flow forecast and economic profit forecast. So now today what we want to do is we want to turn this into a DCF valuation of the intrinsic value model. So using the tabs from left to right, we're going to want to add a new tab to our model. So I'll hit plus. And the tab, which I want to put here at the end, and I'm going to rename this tab DCF for discounted cash flow valuation. All right, and this is following the process that was described in this week's reading in the book, right, which is basically the valuation that they did of UPS and FedEx. Okay? So with that in mind, we're going to create the DCF tab, and we're going to do the cash flow valuation. And so it all prints on one page. We're going to do it in rows versus columns. So the first part of the valuation is the operating value, which is based on free cash flow. So I'll go ahead and type in free cash flow. And what I need is my forecasted free cash flow, which we've created in the model. So as a relative reference, because I want to use this reusable, then we created it off the CFI. So my first year forecast was 2015, so H1 off the CFI tab. And we had forecasted 6 years. We said the first 5 years were basically the individual periods we'd forecast. Year 6 was the beginning of continuing value. So I'm going to have equals previous year plus 1, again, relative reference to the years, for 5 years of explicit forecast through 2019. Okay? And so what I need is I need my forecast year by year for the next 5 years of free cash flow. Again, that was created on the CFI. So for the free cash flow for 2015, I go to the CFI tab, and I have 2015 free cash flow. H12 was that forecast number. So that's the number I have here. Right? 2016 free cash flow off the CFI would have been I12. 2017 forecasted free cash flow off the CFI would have been J12. 2018 free cash flow off the CFI would have been K12. And 2019 free cash flow off the CFI would have been L as in Larry 12. Okay? And to make it easier, I'll put this into 2 decimal places. All right, so HIJKL. So again, if our ratios come true, these would be the 5 years of free cash flow that CAT would generate, right? Now I want to present value these, okay? Because I'm doing the valuation as of today. So in order to do that, I need a discount factor. The discount factor we're going to use is the WACC. On the assumptions page, we actually have a field already here in our assumptions for a WACC. Okay, so here's what I'm going to do. So I'll call it a discount factor. And my free cash flow times the discount factor equals my discounted free cash flow. So the discount factor is 1 divided by 1 plus r to the n or t based on number of periods. So in this case equals 1 divided by left paren 1 plus r. R is the cost of capital. So off the assumptions, the WACC, right paren, that's 1 divided by 1 plus r. Again, I'll shrink this down to like 4 decimal places, make it a little bit easier to see. All right. Now, I'm going to copy this, and I always wanted to refer to the WACC cell, so I'm going to make this an absolute value of $B, $4, and I'm going to copy and paste this down those next 5 rows. And starting in 2016, I want 1 divided by 1 plus r squared, because it's 2 years. Third year, 1 plus 1, 1 divided by 1 plus 1, 1 divided by 1 plus r, the WACC, to the third power. In the fourth year, to the fourth power. And the fifth year, to the fifth power. Okay. So again, the formula for present value is cash flow divided by 1 plus r to the n or t. So in this case, we have cash flow over here multiplied by 1 over 1 plus r to the n or t, and that will get you the discounted free cash flow. If you wanted to use the formula for present value in Excel, skip this whole process, you could do that. That would give you the same answer. But the point is, my discounted free cash flow is the cash flow times the discount factor, and that's my discounted free cash flow for CAT for the first 5 years. So that if I add those up, I get the operating value in first 5 years. And that'll be the sum of those 5 discounted cash flows. So what we're saying is, if the ratios come true, CAT will generate $16.8 billion of value from operations in the first 5 years. Okay? Except CAT is going to be around for more than 5 years. And the assumption we make is that companies last forever. So the forever period, year 6 to infinity, is known as the continuing value period, or CV for short. Okay? So what we now need to do is we need to estimate the continuing value of CAT selling big Tonka toys from year 6 forward. Okay? So here's what we're going to do. We're going to create a field here called continuing value. Continuing value. And I'm going to estimate the continuing value. Now, I had posted, and this was in the readings, in the lecture notes, lecture note 5, and McKinsey talked about in lecture note 5 that the key value driver formula is the formula we use for estimating continuing value. It's the rearranged growing perpetuity. Okay, so this is the formula for continuing value. NOPLAT T plus 1 is, for intensive purposes, the 2020 NOPLAT in our model. So again, when we forecast, we always forecast 1 additional year beyond our defined period. That's why we did 6 years. All right, so the first 5 years are year-by-year forecast. Year 6 was the beginning of continuing value. All right, if we wanted 10 years of defined period, we'd forecast a year 11 to be the continuing value period. So that's what this T plus 1 represents. All right, the G is the very long-term growth of free cash flow into perpetuity. So think of this as like the 30-year long-term growth rate, compound annual. RONIC is the incremental ROIC we earn in the future. Again, practically the 2020 ROIC, right? And then the WACC is the WACC. So those are the 4 things that we're going to need to do our continuing value. So what I'm going to do is I'm going to put those all in one place. I'm going to put those all on the Assumptions tab. Okay, so I need 4 assumptions. I need the continuing value NOPLAT. I need my continuing value G, and then I need my continuing value RONIC. Right? And that RONIC, that continuing value ROIC, is based on the BOY method of calculating it. That's what we're going to use when we do the valuation models. Okay? So I'll just highlight that that's the BOY ROIC as opposed to the EOY ROIC, because 2 tabs exist in the model. All right, so my continuing value NOPLAT equals, off the TII, the 2020 NOPLAT, which is TII, which is row 4, M4 off the TII. Oh, who's doing that? Just kidding. Equals TII M4. Oh, my mouse has it's haunted. M4. There we go. Microsoft, thank you. Thank you for dying. Oh, you kill me, Microsoft. All right, so, sorry, and this is being recorded. It's faster. Let me do this. Don't save. File, open. I'm going to open this file, and I'm going to delete what I did in the last class, since I'm further along. Now I want to retype everything I just did. All right, so total operating value for the first 5 years, and on the Assumptions tab, wipe out assumptions we haven't gotten to yet. So these are the assumptions that I need. I need a continuing value NOPLAT, I need a continuing value G, and I need a continuing value RONIC. Again, it's based on beginning of year. All right, and then let me save, since Microsoft is unstable. BMGT 443. Sorry about this. Model, save, replace. Okay, so the continuing value NOPLAT is going to be TII M4. The continuing value G is going to be 3%. That's our starting point. I'll make that cell yellow. The reason I'm using 3% as a starting point is for mature companies, the assumption is they generally will grow at the rate of the economies. U.S. and European economies for the last 100 years have grown about 3% annually, so we're going to use 3% as a starting point. We can always change it later, but that's why we're going to start with 3%. All right, continuing value RONIC is going to be off of the BOY tab, so equals EP BOY. ROIC is after goodwill, so row 15. It'll be L15, 9%. All right, I'll save this as I keep going along, so don't want to die. So these are the 4 elements of the key value driver equation. So again, I will do my continuing value. And what I need to do with the correct order of operations is put that formula into that cell. So, equals, left paren, and I'm going to do this all off the Assumptions tab, so it's all in one place. So, I take my continuing value NOPLAT times left paren, 1 minus, from the Assumptions tab, continuing value growth divided by continuing value RONIC, right paren, divided by left paren, whack, minus continuing value growth, right paren, enter. That is my continuing value. Okay. I'm guessing you wanted to see that, so I'll double click on the cell, and it's on video. That's the formula with the correct order of operations, I hope. Okay. This is the second hardest thing you'll have to do in this model, is basically get the right order of operations for the continuing value formula. All right, so the idea here is that number represents the operating free cash flow value of CAT based on our forecast from year 6 forward. Okay, so the first 5 years we have a value, year 6 forward we have a value. But we need to present value this, right? Because that's the value essentially at the beginning of year 6. Okay, because the growing perpetuity has a discount factor implied in it. So it's discounted that cash flow to the beginning of year 6. And I need to present value it to today. All right. Now, for all intents and purposes, the beginning of year 6 is the same as the end of year 5. Okay. So I don't want to double discount year 6 because year 6 has already been discounted. So I use the same discount factor as year 5. And then I take that value times that discount factor, and that's the value today, $48 billion and change. Okay, so that's the present value of the year 6 forward. So that my operating value of CAT is going to be the $16.8 billion plus the $48 billion, or 64,881.94. Okay, so that is my forecast, assuming my ratios come true, of the operating value of CAT. Now, operating value plus non-operating value equals enterprise value. So the next thing we need to do is we need to add in the non-operating values. This is where TFI helps us, because on the TFI, we have identified the non-operating assets. They're right here, rows 9, 10, and 11. Excess cash, non-operating assets, long-term investments. Those are the 3 non-operating assets of CAT. So next, what I want to do is I want to use the actual values of those. Now here's the thing. I'm going to use the reported values off of the balance sheet, which are the 2014 ending values, which is the current amounts. And they're already in present value. So excess cash off of the TFI in 2014 is $62.37. Non-operating assets, net of non-operating liabilities, $228, and long-term investments, $16,008. And again, I'll make that 2 decimal places. So if I then add the operating value and the non-operating value together, I get something called the enterprise value, which would be $87,355.26. Okay? So again, I have the operating value of the free cash flows, the value of the non-operating assets, add them together, get the enterprise value. Now the one adjustment that I'm going to want to make to enterprise value involves long-term investments. Cash is cash, so whatever cash they have is really easy to value. It's already a present value, and I know exactly what it's worth. Non-operating assets hopefully are worth near the book value, so I'm assuming the accounts are doing their job, and the book value is representative of the non-operating assets. The one asset that could be a little weird might be the long-term investments, right? Because accountants value things at book value, they don't value things at market value. So if CAT's market value of a joint venture, for example, is substantially higher than what they paid for it, that value would not be captured on the balance sheet. Okay, so think about poor Yahoo, who reported earnings yesterday, had yet another devastating quarter, right? Basically, the entire value of Yahoo is their investment in Alibaba. Right, so the one smart decision Yahoo did is they invested in Alibaba a few years ago. But the problem is that the value of Alibaba, which is really the value of Yahoo, is not on their balance sheet. because what's on their balance sheet is what they paid for Alibaba. It's not the market cap of what it's worth. So I would undervalue Yahoo if I just looked at the book value, okay? Because I'd have to recognize the market value of Alibaba is really what I'd have to value. So here's the same thing with CAT. If this was an Alibaba-like investment, it's probably not, but if it were, then it would be worth far more than $16 billion. Okay, so here's how we'll make an adjustment for that. On the Assumptions tab, starting in row 9, I'm going to call it the price to book multiple of long-term investments. And I'm going to make it 1, and I'm going to make that yellow. And what I'm going to do is I'm going to take my long-term investments and I'm going to multiply it by that price to book multiple. So here's the idea. If I thought that the long-term investments that CAT made in its other business were worth 3 times what it paid, then I put in a 3 times price to book multiple, and on my valuation, it would then turn it into a $48 billion value. Okay, so that's how we can adjust the value of the non-operating asset. Obviously, that would involve some homework. I'd have to go figure out what the non-operating investment was, and I had to figure out what it was worth. But at a minimum, I could at least have the book value in there, which is where we'll start. I'll leave it at 1. But if I knew it was worth what the actual market value is, then I could make that adjustment. Questions about any of this? All right, so next, we have the enterprise value. Enterprise value equals debt and equity. So that's the point. If we subtract all of the debt and debt equivalents, and we're trying to get to a common equity value, if we subtract all of the non-common equity, what would be left was a common equity value of the firm. Okay, so that's what we're going to do next. We're going to subtract all the debt that has to be paid off from the enterprise value. Well, again, this is where TFI helps us, because on the TFI, we've listed the debt, interest-bearing debt, and pension, retirement-related liabilities. So here's retirement. Here's interest-bearing debt. Then I'd also have to pay off, again off my TFI, the preferred shareholders, and I'd have to pay off the minority shareholders. So those are the 4 stakeholders that have to be paid off before the common stakeholders are paid, because common gets what's left after everybody else has been paid. Again, I'm going to use the current amount outstanding, so the 2014 numbers. So retirement-related liabilities equals, off the TFI, 2014 would have been $89.63. Debt would have been 2014, $39,285. Preferred shareholders, they didn't have any, but we'll still make a link to that, 0. Minority shareholders, 80. But basically, those are the people that have to be paid off before common can get paid. What's left would be my common equity value equals my enterprise value minus the sum of those 4 items. 39 billion, 27 million and change. If I then knew the shares outstanding, what I'd be left with is a share price. Now in Bloomberg, and I put this screenshot for CAT in the folder on Elms, under the DES screen in Bloomberg is the quickest way to get the current shares outstanding for a company. So right here is 602.6 million. Okay, so 602.6 million is the current shares outstanding. So that's what we're going to do. What we're going to do is I'm not going to put it here because I'm going to update it every time we do a new company. I told you I don't want to have my updates scattered throughout my model on Monday. So what I'm going to do is on the Assumptions tab, I'm going to create a new assumption called Shares Outstanding. That'll be the 602.6. That'll be yellow. And on the DCF, I'll refer to that And my share price equals the equity value divided by shares. That would be the intrinsic value or estimated share price on a cash flow basis. So here's what's interesting. If we just repeat the ratios that CAT had for 2015 forward forever, the cash flow value of CAT would be $65 a share. Right now, CAT is trading at 71. So we're not that far from its current share price, right? And obviously that would be our next step. And this is what we'll do on Monday. But on Monday, what we'll do is we'll do what's called an as-is valuation, where we'll actually adjust some of these assumptions, the ratios and the assumptions, to get very close to the actual share price. Right? We're not doing that yet, but we've now set up our model so that we could do that. Right? And I could do, and again, don't do this, right? Because I don't want you to do this yet. But I could go in here, for example, on the ratios, I could say, well, CAT's not going to shrink forever. So what if they grow at 3% a year starting in 2017? And I come here to my DCF valuation and I see that $77 a share. So I could do some what ifs to get closer to the stock price. So that was just a random one. Don't do that now. But that's what we'll cover, how to do that in the next class. Okay? But that's what we've set up with our model for the DCF valuation. Does that make sense? Questions about that? All right, so the other tab that we have to create today is the economic profit valuation, right? Also known as EVA. So I said there's going to be two valuations that you got to understand. And again, this was right out of the book. So this was a midterm question. But basically, the only thing that's different between the economic profit and the DCF valuation is how we estimate operating value. Everything else is the same. So to make our lives a little bit easier, we're going to take this tab we just created, we're going to clone it. So using your mouse, right-click on DCF valuation, move or copy, create a copy, move to the end, hit OK, and I now have a copy of the DCF valuation tab, which I will rename by clicking on it, the EP space valuation, or the economic profit valuation. Okay. So now we're going to do an economic profit valuation of CAT. Right? So again, what's different versus the DCF is when we do the economic profits, rather than using the forecasted free cash flows, we use the forecasted economic profits. Multiplied by the same discount factors, we get the present value of the economic profits. Remember, economic profit is change in value. So I don't want these free cash flows, so I'll clear those contents. I want the forecasted economic profits. Now, very specifically, I want the BOY economic profits. In fact, I'll highlight this in here for you, BOY. BOY. Right? And I'm choosing BOY for a very specific reason because I want these valuations to match. Bless you. So for 2015, off of the economic profit BOY tab, the forecasted 2015 economic profit after goodwill, which is this last row, is G23. 2016, forecasted economic profit BOY is H23. 2017 is I23. 2018 is J23. And 2019 off the BOY tab is K23. So G, H, I, J, K. Make sure you're getting off of these off the BOY tab, not the EOY tab. So when we add those up, that's the change in value that CAT is adding to its invested capital in the first 5 years, $4,036.67 million. But CAT is going to continue operating after year 5, so we also need a continuing value of the economic profit. Now that is a different formula than the key value drivers. And again, it was talked about it in your readings, but basically it's that formula. So what we have to do is we have to put that formula with the correct order of operations into our model. Okay? And this will actually be the hardest thing you have to do with this spreadsheet. So there's 5 elements to it. There's something that's new, and it's the economic profit in T plus 1. Everything else is the same as the key value driver formula. Economic profit T plus 1 is the 2020 economic profit. So on the Assumptions tab, that's where I left a space here for row 8, continuing value, economic profit, and again, to remind ourselves, BOY. That's going to be the 2020 economic profit. So equals, off the BOY tab, 2020 economic profit after goodwill, so L23. Right. So, using the data that's on this page, I'm going to go back to my EP valuation and start putting in this formula. Okay, so equals, left paren, working off the Assumptions tab, I'll take the continuing value economic profit divided by the WACC, right paren, plus left paren, no plat, T plus 1, which is the continuing value no plat, times left paren, G over RONIC. So continuing value G divided by continuing value RONIC, right paren, times left paren, RONIC minus WACC. So continuing value RONIC minus continuing value of just the WACC. Right paren, divided by left paren, WACC times left paren, WACC minus CVG. Right paren. If I did it right, sometimes it takes a couple times, I'll find out, but basically I get 25,232.26, which present valued is a change in value of 18,244.59. I'm pretty sure that's right. So the final step in the economic profit valuation is we take our starting invested capital, which in this case is our 2014 invested capital. So off the TFI, 2014 operating invested capital, including goodwill, 42,601. So if I add together those 3 numbers, the change in value the first 5 years, the change in value in the continuing value period, and the initial invested capital, I get the operating value of CAT, 64,881.94, which is the same on the DCF tab as the 64,881.94. And it has to be. That's the theory. 2 methods, same valuation, no difference.
Where'd you get the starting?
Matter of fact, if I put the difference in here, I'll show you in a second, equals the operating value here minus the operating value on the EP tab, notice the difference is 0. It's not I'm off by $1. It's not I'm off by 0.1. It's I'm identical. Okay? And that's why we're using beginning of year invested capital and beginning of year ROIC. Because if we did it on end of year, we'd be close. If we use beginning of year, you get exact. Right? And academically, I wanted to show you exact, which is why we're using the BOY numbers. And last but not least, this is part A of your final exam. Okay? So part A of the midterm exam was convert the statements. Part A of the final exam, here's some financial statements. Show me using both methods, you get an identical valuation. That's what you'll have to do, this exact thing for the final exam. Right? So back to this. Where did I get, sorry, your question was?
Where'd you get the starting invested capital?
So the starting invested capital is the 2014 invested capital, operating invested capital off the TFI. So G7. So that's the idea of economic profit. Economic profit's a spread-based model. What it says is we started with $42 billion of invested capital. We added $4 billion of value in the first 5 years. We added $18.2 billion in year 6 going forward. When you add the three together, you get the overall operating value of the firm. So the spread method is basically saying, are we adding or taking away from the value of the capital we deployed? As opposed to the DCF model, which is a pure NPV of the cash flows. Yes? So the formula for continuing value with the correct order of operations is on the screen. And by the way, this is being recorded and will be posted on YouTube shortly. Other questions? Yes? All I did for the difference, it's not necessary to your model. I'm just showing you that what I did was I took the operating value here and I took the operating value in the DCF and I subtracted them. And I just wanted to show you that there really was no difference. So that's not required for the model. It's just telling you just academically, and that's the point. All this is rearranged equations. Okay? So the value of the company can't change just because we rearrange the equations. We got to get the same answer. And that's all we're proving out here. Right? But there is one reason why we do, and I'll put the equation back up there. One reason why we do the economic profit method is because it does, and Stern Stewart, because this is all based on EVA, right? So Stern Stewart calls this EVA, but because they have the registered trademark for it, McKinsey can't call it EVA. So McKinsey and everybody else calls it economic profit to get around the trademark, all right? But basically, the whole point of EVA or economic profit is it's the value added. So Stern Stewart calls this the market value added, all right? So the idea is, am I creating value just because I spent a lot of money? Or am I adding value to the assets that I put in place? All right. So the difference between the operating value and the actual invested capital is the value that Cat added by selling big Tonka toys. Okay. So basically that's the insight we get. And the problem with the cash flow model is the cash flow model doesn't tell us whether or not they added a lot of value to their assets. It just tells us this is how much cash flow they're generating, regardless of the assets that were employed. Right? Now, that's the same answer. And ultimately, that's the value that I get. I get the value of the cash flows. But this at least tells me two additional things. One, how much value did I add? And two, when is the value being created? And I can clearly see that most of the value for CAT is actually being created year 6 beyond. It's not the first 5 years. Okay, so the first 5 years kind of matter. But what really matters is that long-term continuing value period. And so there's a bet that CAT will do well in that period in order to create that value. And that's going to be key to the valuation. Yep.
Just one more second on that formula.
One more second on that formula? Sure.
Yeah.
All right. So if you've reached this point, you need to save your file, and that's the other half of homework 7. Okay, so you can upload this to Elms along with the model data for Komatsu exported, right? And if you've done that, you've completed homework 7. And this is where we're going to pick up on Monday. Okay? So what we're going to do on Monday, following the process that Nicole, the analyst from Morgan Stanley, talked about, is that we're going to finish creating what's called an as-is valuation. Okay? And it's as it sounds. We're going to take this file, and we're going to take CAT's current stock price of about 71 a share, and then we're going to make changes to better understand what assumptions must the professionals be using on a cash flow basis, intrinsic value basis, to justify the current stock price. That's called an as-is valuation. Okay? Then we're going to create the scenarios. So again, Nicole from Morgan Stanley talked about creating a bull case and a bear case. So we'll do the same. So we'll put in some changes to our assumptions and ratios to create a bear case, and we'll put in some changes to assumptions and ratios to create a bull case. So essentially we'll have 3 things. We'll have the current stock price in the assumptions, we'll have the bull case in the assumptions, we'll have the bear case in the assumptions, and then we decide which one do we like best. That becomes our target stock price, and that becomes our buy, sell, hold recommendation. Okay, so that's the point. If we are optimistic, and this is what it would take for the optimistic scenario to come true, then that's what we think CAT's worth, and that's why we think we should buy. And the general delta is about plus or minus 10%. So if we're plus or minus 10% of the current stock price, most analysts call that a hold. And they say it's just a trading range. Okay, so it's not really a reason to buy it, because it really says that the company's kind of worth its intrinsic value plus or minus a little bit. There's no really reason to buy the stock. Hold it if you got it, but don't really buy it if you don't, because you're not really going to get a lot of upside, right? So the buy says that there's more than a 10% appreciation opportunity. And what we're doing here is we're calculating what's called intrinsic value. We're saying based on the cash flows, this is the present value of what those cash flows are worth. So there's a big delta between that and the current share price. Then there's a reason to buy or sell. Okay? But in a way, this is one method for creating our target stock price. The other thing we're going to do on Monday is we're going to introduce the concept of multiples. Okay? So we'll talk about the final valuation methodology of how we create multiples and how we understand multiples. We'll create multiples for CAT. And we'll talk about CAT's multiples versus other companies' multiples, using it as a sanity check for evaluation and an alternative method of valuation. There'll be a homework assignment on Wednesday about that. Once we've completed that, we're done with content for the semester. Because for your group project, I said there were 4 things you got to do. And by next Wednesday, we would have completed all 4 of those things. So 1, you had to do an EIC. 2, you had to do historical financial analysis. That was the CFI, and that was the ROIC tree, which are already in the model. 3, you have to do a multiples, which we're going to talk about multiples next week. And 4, you have to do a valuation model with your buy, sell, hold recommendation target stock price, which we're completing right now. So basically, that's it. That's what you're going to have to put together for your group project for the companies that you've selected. And you'll have about 3 weeks to get that done. Okay. So again, 10-minute PowerPoint and about a 12 to 15 page paper. All right, basically covering those 4 sections. That's what the group project is going to be about. But essentially, we're almost done with what's necessary to do that. And because we've already covered EIC and historical, you could actually start on your group project today. The one thing that will be important is to basically get the model for Komatsu written and for CAT, because you'll take your company that was selected and that data and export it and update this model. And on Monday, I'll show you how to do that as part of the Komatsu alternative valuation. So that's where we're going. That's our roadmap. Questions about any of that? Right? And again, I think I mentioned this to other sections on Monday, just as a reminder. So the week of November 9th is going to be the BAT week. Okay, so told you at the beginning of the semester, Bloomberg offers the Bloomberg Achievement Test. So it's going to be offered on Monday, November 9th and Wednesday, November 11th. Right? On November 9th, the BAT is going to be offered at 11 a.m. and 2 p.m. It's a 2-hour exam. Okay? On Wednesday, November 11th, it's going to be offered at 12:30 p.m., this section, and 3:30 p.m. Again, it's a 2-hour exam. Right? So if for some reason you have a class right after this, you can't take it, you could also take it at one of those alternative time slots. Right? So there's 4 time slots during class in the lab that you'll be able to take the BAT. So the way it works is you can't really study for it because it's kind of like the SAT, just test general business knowledge. It's a web-based exam, and it's proctored by Bloomberg. So somebody as a Bloomberg representative will be here watching you to make sure you're not cheating. And it's a timed exam where you have to finish in 2 hours. So that's extra credit. So if you take the exam for extra credit, there's no cost to you if you take it during this section. Bloomberg is waiving the fee. And you get 5 bonus points towards your semester grade. Okay, so as I said, you don't have to take it. Can't hurt your grade, can only help your grade, because you're only going to be scored out of 100 potential points, but this is the extra credit for the semester. Okay, so if you think you'll need extra credit, you probably should take the BAT. Yes?
You have to pass it to get the points?
No. So let's say you bomb the BAT, which I hope you don't, you could still get the credit by taking the BAT. Okay, now here's the thing about the BAT. The BAT's a score that could help you get job interviews and potentially a job. And it's attached to your Bloomberg account. However, it's opt-in. So if you do bomb the bat, nobody but you and your pride will know that. Okay? If you do well on the bat, then you can opt in and you can make your score available to the Bloomberg community so that HR representatives searching for people might find you in a screen. If you opt in, the way it works is they don't actually give your name, they give a Bloomberg ID and a score. Okay? And then they actually have, I think, 6 or 8 sections. They actually score you by section. So if people want a certain score in a certain section, they could actually say, I want people that know this type of material, as opposed to just their whole score. But regardless, it's posted. If an employer wants to talk to you, they then contact you. If you want to talk to the employer, then they're given your name. Okay? So you, A, don't have to opt in, and B, even if an employer finds you, they don't get your name unless you tell them it's okay to have your name. Okay? But regardless, we had 130 people take it last semester. This semester, out of 160 students, I'm hoping it'll be even more since I'm giving you class time to do it. And then the final part is if you can't take it during any of the 4 offerings during class, they do offer an online version which is paid. But Bloomberg is giving me a limited amount of free codes so you can take it at home. Right? Except, here's the thing. If you take it at home, you have to take it on a computer with a webcam, because basically the webcam will be active and somebody at Bloomberg will be watching you for 2 hours through your computer while you're taking the bat. Okay? Seems kind of eerie and spooky to me, but that's, again, the way that they do the cheating, anti-cheating. So that is an alternative if you can't make one of the 4 sections. Now, if you've already taken the bat this semester and you can prove it, then I'll accept that as extra credit, right? If you didn't take it this semester, then you have to take it again. Okay, and by the way, you can take the bat 2 times. If you don't like your first score, you get a better score, and the second one, you can replace your first score with the second score of what goes out to the community. So that's the bat. It's coming up the week of November 9th and 11th. So just giving everybody a heads up on that one. Okay, questions again about anything? Yes?
So you're not registering for it, you just come to class?
Yeah, so what will happen is, since you're going to be here and taking it in class, Bloomberg will know who you are, and they're going to give me an Excel file of all the people that took it during the class. And based on that Excel file, you get credit. If you take it at home, then just like your certification for Bloomberg, they'll give you a PDF at the end, and you'd have to upload and show me the PDF to prove that you did it, or to the TAs. Yes?
So do we just show up that day?
Yep.
They'll be like directing me?
Just show up that day, you'll take it on a terminal in this room, and just take the bat. Now, here's the thing. There's only 25 terminals, and I see a blue screen of death on that one, so they're not all working. And so if there's 40 people that show up, and there's 25 terminals, some of you will need to bring your own laptops in order to take the bat, because you have to use a computer to take it. So that day, if you do show up, I'd say, and you probably do want to bring your own laptop, looking at the blue screen of death on that machine over there. So again, same thing that applies with the midterm. Like, you don't want it to crash in the middle of everything. But it'll be done in the lab. And they don't watch you on webcam. They'll actually be physically somebody as a representative of Bloomberg here just proctoring it during the exam time. Right? Got any other questions? All right, so again, we'll give you more insight into that. So, reminder, stock track, first half of the semester ends on Monday. The write-up and submission will be due on Wednesday. We'll talk more about that on Monday. But basically, your first half trades need to be complete by Monday, and the write-ups have to be submitted by Wednesday. Okay, so homework 7, 2 parts. Part A, if you finish what we did in class, save, submit individually. It's not a shared file. Part B, create the model data using the CAT model as an example. Download and export Komatsu's data, and then upload that as the second Excel file. That's what's required for homework 7. Otherwise, see everybody on Monday. And I will post this video to YouTube shortly. Stop recording.
Can our group change its company?
Sure.
Cool. Just so you know.
Let me just say this. What is today?
The 21st.
So what company would you like to change it to?